This is the Borderless Crypto Podcast. Hello everyone, I'm your host, George Manloff, and in this series I bring you exceptional investors, entrepreneurs, hustlers, and thought leaders from the cryptocurrency space. This time I present you Hart Lambur, the CEO and founder of Universal Market Access, also known as UMA. UMA recently took over crypto media with the announcement of the USStocks token, which allows anyone with access to the internet to participate in the US stock market. The fact that UMA breaks literally all financial borders made it absolutely necessary for me to have them on the podcast. While the project is still in early days, its potential is hard to understate. UMA is building the infrastructure that will allow even the people in the lowest income bracket to build a diverse investment portfolio or to get exposure to assets that are today accessible only to large institutional investors. This conversation was super interesting for me. Hart is an extremely intelligent person on a mission to break financial borders. He helped me learn what financial derivatives are, how you can benefit from the price increase of an asset without actually owning that asset, and how transparent financial derivatives built on UMA will positively affect the financial world. I hope you enjoyed this talk just like I did. Please note that anything that I or my guests say in these talks is for informational purposes only and should not be treated as investment advice. And although during daylight I'm part of the team behind the crypto lending platform Nexo, at night when I do these talks, I share only my personal thoughts which in no way represent Nexo's opinions. Now it's time to get the podcast started in 3, 2, 1. Hart, welcome to the podcast. I'm extremely excited to have you here. So before we jump in deeper into the UMA project and you tell us what you do and how this is groundbreaking for the global financial ecosystem, can you just introduce yourself and tell us a little about where you come from? How did you get to the crypto space?
Sure, George. Thank you so much for having me. For background, I studied computer science in my undergraduate education and ended up working in finance as an interest rate product trader at Goldman Sachs in New York for 8 years through the financial crisis. So that taught me a lot from my CS background. And then I started a fintech business called OpenFolio that lasted 4 years and it was acquired about 1.5 years ago. And that let me go full head on into crypto about 1.5 years ago with this project.
And when did you discover crypto? Was it after you exited your prior company or?
I was able to discover crypto in 2013 when I was just leaving Goldman. I was fortunate enough to work and be friends with one of the founders of Coinbase, who was also at Goldman at the time. So that was pretty lucky. But crypto or blockchains to me has always been super fascinating as this perfect combination of a lot of my interests in economics, finance, computer science. I really look at it as a way of programming incentive structures. And I think that's super, super cool, super interesting, and really powerful. So I look at this as being one of the first ways that we can actually program incentive structures and use code and economics to incentivize how people behave and respond.
Okay, so the reason I invited you here to talk on the podcast, and the reason why I got super interested, obviously, was the headline that just a few weeks ago went through the whole crypto space, that you have allowed, that you basically have empowered anyone, anywhere to access the S&P 500 index by allowing them to buy a token, which represents that index. So before you tell us more about how this works, can you explain how did you come up with the UMA project and what was the reason for UMA?
Absolutely. Financial derivatives are this really powerful concept in finance. And really how we came up with it was I was going through the history of financial innovations in traditional finance that have led to this development of this deep, sophisticated financial infrastructure we have, and thinking what the crypto version of these things could or would look like. And then in this process, I came across very quickly financial derivatives, specifically synthetic over-the-counter swaps, which we can go into more detail on what I exactly mean by that, and realized that in crypto, this could take the form of a super powerful protocol, essentially, to allow people to transfer risk and access financial risk over the blockchain.
Okay. So in that sense, can you then tell us a little more about what UMA actually is?
Sure. Why don't we start with just how this synthetic over-the-counter swap, what this thing actually is and what it allows.
Okay.
And the example I usually like to go with is just, say, George, say you and I want to trade risk on something. I use the word trade risk, but we could bet or hedge or invest. You say want to go long gold.
Going long means I believe the price of gold will go up.
And I want to go short gold.
Going short means Hart believes the price of gold will go down.
And you could do that by buying gold, and I could borrow gold and sell it short or something like that. But the other way to do this in traditional finance is that we enter into a financial contract, a derivative agreement between the two of us, which is effectively a legal contract traditionally, where I say I'm going to pay you the price change of gold. If gold goes up, I'm going to pay you so much money in, say, a year's time. And if gold goes down, you pay me. And this financial derivative is a super flexible tool because effectively we've just bet on the price of gold without either of us having to move gold back and forth. We've done it without either of us even needing to own gold. Now, that agreement is super powerful because we can basically trade anything we want, anything that we can write in this contract. But of course, this contract's only useful if we both believe the agreement will be honored. And so how do we secure that? How do we make sure that happens? Well, in the traditional world, we have two mechanisms to secure this agreement. We have what's called margining, where you and I post-redeem collateral, something of value, as the value of that contract changes. And we have legal recourse. So you could sue me if I don't follow the terms of the trade.
Okay. And how does it work in the traditional financial world? Like we use some sort of intermediary, I imagine, or?
Yeah, we use both an intermediary, typically kind of called like a clearinghouse or, a futures clearinghouse or something like that. And we also operate within a well-known and very expensive legal infrastructure. So in the types of derivatives I'm talking about, they're really only accessible to institutional financial players, mainly European or American entities. They're completely inaccessible to us because it would cost too much to litigate or to enforce the legal process on us for these types of derivatives. And so it's very much a permission system. This type of trading isn't accessible to the vast majority of people. So this kind of brings us to what we're doing and how crypto fits in here. We like to imagine a hypothetical world, right? So the reason why you need legal recourse in traditional derivatives is that it takes too long to move money or to remargin a contract. It takes at least a day, even in the big $100 million traditional financial derivatives. It takes a day to remargin them, to move money back and forth. And so you need this backup mechanism of legal recourse to secure these agreements. But suppose there was this hypothetical world where you could move money instantaneously and you could value that contract instantaneously and independently. In this hypothetical world of instantaneously moving money, you could theoretically have continuous real-time margining of your contract so that money is always moving instantaneously as the value of your financial derivative changes. This concept is super cool because what this would mean, theoretically, is that you could secure these contracts with margin alone. There'd be no need for legal recourse. You could always just instantaneously remargin your contract. And the person on the other side would never be afraid of losing money because they'd always have their margin, their collateral posted into the financial derivative itself.
Okay. And so this hypothetical world that you're describing, isn't this essentially what crypto is? Because in crypto, you can move money fast, like very fast, way faster than the traditional financial system. So is this what you're referring to, or?
Yes, spot on, with a couple caveats. So in crypto, you can move money very, very quickly, but you can't quite move it instantaneously, right? Nothing is instantaneous. But this gives us a lot of tools because let's say, George, going back to our example of us betting on gold, you want to go long gold, I want to go short gold. Let's say we can move money on a blockchain within 5 minutes. to finality, just as a number. If you and I both believe that gold will never move more than 10% in 5 minutes, we can design a financial contract where we each deposit at least 10% of the notional of our trade at every moment in time. Mm-hmm. And in terms of this contract, we lose whatever that margin deposit is if we don't remargin and add more money when we're supposed to. And what we've now designed in this simple hypothetical example, we've designed a self-enforcing contract where you and I both have an economic incentive to remargin and make good on our trade so long as gold doesn't move more than 10% in 5 minutes. Otherwise, we'll lose that collateral as this default penalty.
Got it. So basically, you're using the blockchain to create a globally accessible system where any individual, any company can enter with other individuals and companies into derivative contracts without having to rely on a specific jurisdiction or specific legal system to be sure that this contract is going to be enforced. Is that correct?
Yeah, that's right. So it's this infrastructure to let people, we like to say transfer risk, almost like a protocol to transfer risk that is permissionless and globally accessible and uses crypto as the infrastructure to enable all of this.
That's super powerful. And then for me to understand and for our audience to understand, in practice, what is UMA? Is it a website? Is it an app? Is it a protocol? And who and how can enter in these derivative agreements? So basically, who can transfer risk? Who can bet on certain stuff? Who can get involved in this system that you're building?
So good question. We are a protocol, essentially a platform to build these financial contracts. And it's meant or intended to be accessible to anyone that can legally access it. So for example, these types of agreements are not accessible to American people or US people for various reasons. But we are just the infrastructure. We're just providing the technology, the smart contracts, the tools to actually create these contracts. Now, for the initial kind of first use cases, we've tried to simplify this a little bit. So in this example, we talked about this gold contract where you and I are betting on the price of gold. That requires us both to be fairly sophisticated financial counterparties where we're watching these contracts and we're remargining as the value of the contract changes. And that's actually kind of a lot to ask. So what we've done in the very first use cases is we've created a slightly simpler version of the contract where one side of this agreement, this swap contract, fully collateralizes their position, puts in 100% of the margin on their side, and then tokenizes that position to create an ERC20 token that represents synthetic long ownership in that underlying derivative. And so that's quite a mouthful, but effectively, we've used these financial derivative smart contract technology to create a mechanism that allows what we're calling a token sponsor to create tokenized derivatives that are fully collateralized and that can then be traded as ERC20 tokens and represent synthetic exposure in whatever the underlying contract might be.
Or in other words, instead of me entering in some small derivative agreement with some other entity, you have one entity, so to say, which is like which is building this derivative contract, and then it's a big derivative, so to say. It's a major derivative. I guess it has some sort of value. Like how much collateral have they? And first of all, I guess to start, probably who is this person? So it's not you because you're just providing the infrastructure. It's not you who have created the token. It's not you who are allowing people to invest now in the S&P via just buying tokens. There's somebody else, right?
Yeah, I mean, again, this protocol is designed to be permissionless and accessible to kind of whomever. In the early days, we don't want this to just be mayhem. People create tons of things in the world. So there's a Hong Kong-based crypto market making firm that has used this technology to create the first product using the UMA smart contract. This first product is called USStocks. It's a token that tracks the 500 largest stocks by market cap in the US. And this token is currently listed on a decentralized exchange called DDEX.
Okay. But so Does this really work today? Because I mean, I guess there's two propositions here for UMA and what you're doing. On the one hand, like more sophisticated people can enter into derivative contracts, but on the other hand, anyone, anywhere can just go on DDEX or I guess in the future, other exchanges and buy an ERC20 token, which represents this 500 stocks. So does it work in the sense that, for example, I went on DDEX where this token is listed today and where anyone can buy this token. And I mean, there were just a few buy orders, there were a few sell orders, but it's not like there's a real liquidity there and people are buying and selling. So I imagine what you have launched is more of a showcase at this point, or?
Yeah, that's right. We look at this as like a proof of concept.
Okay.
And so again, we don't know what products people want, or really who wants to create those products, what people want. That's the big experiment to figure out. And that's the whole fun thing about crypto, right? Is there's this whole new world of innovation, making new financial products accessible to lots of new people in different parts of the world or different regions that no one's ever served or even thought about before. But we are in this interesting position where we're just providing this framework to help people create these products. And it's a big open question to us what people want to use this for, what they want to build, and where market demand will come from.
Okay. And so for example, because as I said, and you said it's a proof of concept, and I also saw that this token that is currently people can buy and it's tradable, it's going to get, I'm not sure how it's the best way to describe it, but it's going to be redeemable. So the derivative contract is going to get closed on May 15th. So this is not really, so to say, the moment when anyone anywhere can trade it, can get access to the S&P 500. So do you have an idea of where that would actually become possible for a wider audience? Or it's like you're just letting the market play out and cannot really have any say or you cannot do anything about it?
Right. Very early days. And we're pleased with how this first proof of concept has gone, and that the underlying platform is working. There's more than $1 million this product that exists, which is pretty cool. And, it hasn't broken. So we feel really good about that. And it's been working. But we're going to be heads down, just working on improving the different types of contracts that can be created. We're also working on a pretty innovative decentralized Oracle design that really removes or provides credibility around the price feed being used to value these contracts. And in parallel to that, we are trying to get out there and understand what types of products people want to create in what types of regions. And so, we're really just trying to foster an ecosystem to grow around this.
Okay. And when you say you're trying to foster an ecosystem, so who's your audience at the end of the day? Is it traders? Is it coders? Is it institutional investors, small individuals, or market makers? Maybe do you have right?
It's a great question.
Group of people you're talking to, or you want to learn more about you.
It's a great question. Really, I think that our immediate audience are market makers and maybe exchanges that are looking to create new products to service their users. And I really say this as in the first step on using our technology is to function as what we're calling a token sponsor to create a new derivative token that tracks something. And so those people are kind of our first market. So in a sense, we've got a B2B problem. We've got to find these other businesses or other entities that want to create these. And then, of course, those entities, those token sponsors, want to create products that are demanded, that have demand from the end consumer, from whoever's going to buy them. So that's the interesting trajectory we need to follow, which is finding people who have really innovative ideas on products they want to create for a certain type of user, and then helping them create those products, and then providing the technology to help them create those products. And then hopefully they are able to sell those products to their end users.
Okay. So I guess the exchanges or the market makers who would make a big difference is, the big players in the world, like Coinbase or Bittrex or some of the big exchanges. Because, for example, on DDEX, in general, decentralized exchanges, for many reasons that we don't have to discuss at this point, there's just not a lot of volume there, the go-to place, so to say, for crypto traders. So do you already have interest from the largest established players for the creation of such type of products?
I think we've talked with a number of people in the crypto space, And people are very interested by what we're doing. What I think is an interesting idea to think through, if you're a crypto exchange, at some point, do you want to just stay a crypto exchange? Or do you want to just become an exchange that lets your users buy or sell anything they want to buy or sell? And I think that at some point in the future, and I'm not sure when, timing will be difficult here, but at some point in the future, I think it makes a lot of sense for crypto exchanges to just become exchanges where you can buy and sell crypto product, but you could also buy and sell gold, oil, the S&P 500, whatever else.
Okay. And this is what you're enabling with your derivatives contract. So basically, because at some point it's like you are enabling people to trade stuff without actually owning it.
That's right.
So would you say that derivatives are a good tool for you to trade, for example, even fiat? Does it make sense to enable people to trade the US dollar and euro using your tool? So in a sense, provide a product that is an alternative or a competitor of the stable coins out there, or not really?
Well, I wouldn't say we're competing with the stable coins for sure. The Maker team, for example, their DAI is the margin currency for the first product that was created using our technology, this USStocks product. And I think that the stable coins have a very important role. But I think there's a deeper question to kind of what you're getting at, which is just how do you trade or own risk, or what I'm calling risk kind of abstractly. And, George, you can go and own risk by actually having a certificate that says you own something. Or gold's a great example. You can own gold by actually physically having gold, under your bed. Or you can own Apple stock by having a brokerage account that is a custodian of shares that say you own Apple stock, right? And they entitle you these rights and privileges. And it's a very physical way of owning risk. There's an alternative world, right, where you don't actually physically own those things. You instead enter into contracts that say, pay you the price return of whatever these assets are. So you enter into a contract that you believe, and you believe it because of the economic design of it, the crypto economic design of this contract. You enter into a contract that says you own so much gold, or you're going to get paid the price return of so much gold, or you're going to get paid the price return of so much S&P 500 or whatever else. And so there is this alternative world where you can use contracts to invest, quote unquote, invest in everything. And it's a pretty interesting world to think through, because that world is very globally accessible. As long as you can write that contract with anyone, that means that anyone can actually access and invest in anything. And I think that's pretty cool.
That definitely sounds absolutely amazing. Now, on the other hand, curious to find your thoughts about if this creates some also dangers, so to say, because what you're doing with derivatives, when you're entering into such contracts where you are betting on the price move of any asset, you are essentially expanding the financial system, right? The financial ecosystem in a way which, I would imagine could create some risks. Right. So Warren Buffett famously said that financial derivatives are weapons of mass destruction. So in that sense, the fact that you are going to enable this point, something that you stress a lot in your white paper is that so far the creation of financial derivatives and trading of financial derivatives has been largely limited to institutions, right? Your average individual couldn't create and couldn't trade such derivatives. The fact that you're with the UMA protocol, hopefully maybe you're going to enable anyone, anywhere to do this. I imagine at some point you could create this huge amount, just expand the financial world in a huge scale. So do you think that would increase the risks of systemic risks in general and just huge collapses or potential financial struggles?
So it's a great question. I think I'd separate the systemic risk question from the other question of what happens if a lot of people have access to financial markets that didn't previously have access to financial markets. So the systemic risk question, and a lot of Warren Buffett's quote here, is because the classic design of over-the-counter swaps and derivatives was totally opaque and nobody knew what their risk was. And it created this cascading, horrific collapse of financial risk because all these contracts were actually totally opaque and nobody could figure out what their risk was. So I'd actually argue that the type of approach we're promoting and the type of approach I think crypto in general promotes really dampens systemic risk because people can really see what's going on. It's on the blockchain. You can read it. You know what your risk is. And I think that's something that's very good from that perspective. But your second question around making markets way more accessible to a lot more people, I will say for sure that could be very scary. Financial education is a big problem, or really the lack of financial education. Even in the US, arguably, the most developed financial marketplace out there, there's still so much miseducation or misunderstanding about how to use financial products correctly. And I think that's a problem that we globally need to attack and tackle. We can't just go like head in the sand. I don't think the right approach is to limit access to the products people have. I think the right approach is to focus more on the education and understanding of how these products should get used, and to really incentivize the creation of responsible, reasonable financial products that help people actually achieve their financial goals.
On this point that you're saying, I guess whatever you're saying or doing, you cannot really prevent people burn themselves. The moment you give them access to a certain type of instrument, and if it's easy and if it looks attractive, they're going to just try it out. They may get burned, like for example, a lot of people got burned with the ICOs and the bull market, which all of a sudden basically gave access to anyone globally with anyone who's a little more curious to just invest and trade stuff, which beforehand probably he could never do. So probably people get burned, but I guess once you get burned, easiest way to actually learn, right?
Yeah, I agree with that.
So I think I tend to agree with you that giving universal access is great. And even if people do some mistakes, that's basically the best way they can learn. So another question which I've been thinking a lot as I read about UMA and as we're talking here, you're explaining how UMA is building the infrastructure for these contracts to be built. And other people are going to actually build these contracts. Other people are going to build these investment tools. So what is your financial model at the end of the day? I mean, I know that you have raised from capital from some leading investors in the US, but is your plan to continue raising or how would you monetize a protocol in general? Like for Ethereum, let's say they have tokens, but do you have tokens, or what is your approach there to just building a sustainable project?
Yeah, no, it's a great question. So what these financial derivatives require at the end of the day is a price feed that can be used to value them and value what the payouts between the counterparties should be. And so our revenue model is basically all centered around that price feed. And in crypto, people generally call this the Oracle problem. Like, how do you get off-chain data onto a blockchain? And we intend on monetizing by creating a very, very verifiable, a kind of provably verifiable Oracle system that can resolve disputes around any settlement of any of these contracts. And that will have a token. In our design, we have this interesting design where we believe we need a token to credibly build this decentralized data verification mechanism. And that is how we will monetize the project.
Wait, so if I enter in a contract with somebody else and then we have disputes, I'll use some sort of your system, or I will have to pay to use your Oracle system? I didn't quite get it.
Yeah. So, it's not all designed yet. We'll be publishing a second white paper outlining the high-level understanding of how this works in the near future. But that's effectively right, what you outlined, where we will charge a small fee to access not the system. Anyone can access the system, but to access this dispute resolution mechanism if you were to dispute the settlement price, this price feed. So basically, counterparties would be paying a small fee, and this fee varies according to the properties of the system, but a very small fee to have access to this credible data verification mechanism that will settle any disputes and what the final settlement of a contract should be.
Got it. Okay, cool. All right, Hart. So cool. With that in mind, I want to enter in a few final questions that are not necessarily directly tied to the project. Would be curious to learn a little more. So you mentioned that you got very early in the crypto industry. What made you enter the industry? Was there a particular person that got you in? So you mentioned you had a friend in Coinbase. Was it him who got you in? Was it that you read something online? Like, what was this moment where you realized that crypto is going to be huge?
Yeah, it was actually Fred Ursum at Coinbase, one of the co-founders of Coinbase, that was I knew from my time at Goldman. And he was the guy that I was friends with before he started Coinbase and before he joined Brian at Coinbase. And I actually had a lot of fun in the very, very early days of Coinbase, watching them grow like wildfire. So sort of a different use case where I actually saw my friend's business taking off. And it kind of opened my eyes to the fact that this Bitcoin thing was really a thing.
Okay.
And it just made a lot of sense to me, as the type of, as a computer science financing person, this type of technology or product made a ton of sense to me. And, in hindsight, it's funny because I left Goldman and had started my own business. It was this fintech business. And I think if I hadn't started that business, locked me into doing that for 4+ years, I probably would have started a crypto business a lot earlier. But, it all worked out.
Okay. And I'm also curious if you're open to sharing some general kind of thoughts on this. So as you said, you come from a very computer science and financial background. So how does a person like you look into crypto investments when it looks to managing your personal finances? Like, do you have I'm sure you have a particular strategy that you're following when it comes to crypto. So would you be open to sharing, what is your approach? What is your mantra, so to say, when it comes to crypto assets?
I'm very open to sharing it. I think it's remarkably unsophisticated. I really am just a hodler, nothing more. It's funny because in my job at Goldman, I was a trader. That was my job. I traded with institutional clients all day, every day. But trading is not a good way to manage your personal money, in my opinion. It's best just to have a diversified portfolio of assets or risk that you believe in, and to rebalance that portfolio occasionally, but really to close your eyes and not think about it. So I trade crypto very rarely. I just own some and hodl it. And I look at it as an investment allocation alongside the rest of my investment portfolio. So it's just another asset class that I'm invested in for the long run.
And so if you feel comfortable sharing, what size of your portfolio does crypto constitute of it? Because there's all kind of cases where people own a lot or dedicate a lot of their portfolio or a small chunk of your portfolio. So how do you look at that? And do you maintain this stake or do you increase it over time?
Yeah, I guess it's changed a little bit. Generally speaking, my percent allocation kind of changes as crypto prices change. It's a volatile asset class. But I think right now I probably have about 25% of my portfolio in crypto. And, given its volatility, and that seems like a lot. I think, if I'm going to provide a little bit of general, how should you look at crypto advice, it really is your risk tolerance and your age and your investment goals, right? So I think that any financial advisor would tell you that you should really only have invested in crypto what you're pretty comfortable losing. It really is a speculative investment. That's just to be safe. If you're trying to buy a house in the next 2 years, putting that money in crypto is probably not a very good idea. But if you are young and have some risk appetite and, want to hold this thing for the next 10 or 15 years, I think having, a real allocation of this asset class in your portfolio makes a lot of sense.
Okay. A couple of final questions. So I'm sure you follow a lot of people in crypto, but is there someone in particular that you recommend our audience to be following just because he or she is insightful and then can help us navigate better through the crypto waters?
That is a very good question. I subscribe to the Token Economy newsletter that Stefano and Yannick put out that I think is an excellent overview of kind of what's going on in crypto. I think Chris Berninski, who's one of our lead investors at Placeholder, I think he wrote a book called Crypto Assets. So he literally wrote a book on the topic. I think his understanding of the crypto market and his general just thoughts and views are really impressive and worth hearing. And then I'd also say Fred Ursum's blog posts. I don't think he's written one in a while, but I think Fred Ursum's blog posts are very insightful on the direction of where crypto's going.
Awesome. Yeah, I can definitely confirm for all of you are saying, but specifically Token Economy has been also an amazing source of high quality kind of crunch of the most important stuff happening in crypto that I've been following, can also recommend as well. Awesome, Hart. So with that in mind, where can people find you? Where can people find more about UMA? And there's anything else that you want to share? Now is the time.
Well, thanks, George. Thanks so much. Yeah, you can follow me on Twitter. My Twitter handle is HAL2001, HAL 2001. And for more on UMA, the Twitter handle there is UMA Protocol. And our website is umaproject.org.
Awesome. Okay, great. Thanks again for being here. It's an extremely interesting project. I think you have a lot to do for not just the crypto, but the overall space of finance globally. So I keep fingers crossed that you reach your goals.
George, thank you so much. It's been a pleasure.
A couple of things before you take off. First, if you enjoyed this episode, be generous and share it with your best friends. They deserve it, they will appreciate it, and they will be grateful to you. Second, I named this podcast Borderless Crypto because I have been fascinated by the speed with which crypto has been breaking financial borders. Just like the internet empowered us to communicate and share information with anyone, anywhere, 24/7, 365, crypto is empowering people of any country to transact freely, to invest in all sorts of assets, and to access capital to grow their economic status. I'm super pumped to be part of this financial transformation. That is why I'm doing this podcast, to spread awareness about crypto and to accelerate the removal of economic borders. If, like me, you want to see a borderless financial world, help me spread the word about crypto even faster by spending 1 minute to rate this podcast, write a review, and subscribe, so that more people learn about crypto, and in this way, together with you, we accelerate crypto adoption. Finally, if you have any suggestions, feedback, or anything you want to tell me, send me a message on my Twitter handle at borderlessbtc. Thanks for tuning in, and I'll see you soon again.